There we go. All right. So thank you for being here. We are going to get started. This is recorded, and Crystal's going to be behind the scenes monitoring the chat and the participants. So if you have questions, throw those in the chat, and either I'll cover them as we go, or we'll circle back around and make sure that all your questions are answered. So in this webinar, we are going to share with you what is called the Retirement Scholarship Strategy. So, which we're super excited about to share with you because it will show you how to send your student to any college of their choice and get all of your money back in retirement. So that's a full refund on the cost of college back in retirement, and you don't even have to get any scholarships or any financial aid for this to work. So whether you have an exceptionally gifted student or a student that is gifted in other ways, or whether you're low income or you're high income, this strategy will work for all of you. And you don't have to start when the kids are young, even if you have students in high school or in college, this strategy applies to you. Um, and there that is. All right. So basically, this applies to any parent who is helping any student pay for college. If you aren't planning on helping your kids pay for college, there's no shame in that. It's just that this strategy probably won't apply to you. But even if you're planning on spending $500 a month or $1 million for your kids to go to school, in either scenario, if you're planning on helping your kids pay for college, this strategy is going to apply to you. Okay, so there are actually 4 college funding secrets to cut the cost of college. We are going to focus on secret number 3 tonight. Secret number 1 is how to maximize that free money and reduce the sticker price. That is maximizing that free money like scholarships and financial aid from the schools. The second secret is how to reduce the college loans and the college loan payments. If you could cut your college loans in half, then you're actually cutting your cost of college in half. So even though you may not want to use student loans to pay for school, there may be a strategy where it actually could save you a lot of money. Secret number 3 is our focus tonight, which is the retirement scholarship strategy, how to get an entire refund on the cost of college back in retirement. And then secret number 4 is what we call retirement restoration from college funding, where we can actually triple our income. There are 3 strategies that we teach to triple our retirement income and make up for helping our kids with college. Okay, so secret number 3. This is the biggest savings of all, the retirement scholarship strategy. It is getting you all of your money back in retirement. So if you help your kids pay for college and it costs you $1 million for 5 kids to go to school, we are going to show you how you can get all of that money back in retirement. And it works at any school. Public schools, private schools, community colleges, trade schools. Maybe your kids want to get a certificate instead of a college degree. It works for everything. In fact, your student could even go overseas and study abroad. It would still work in that scenario as well. Again, it works for every student, your exceptionally gifted students or those gifted in other ways. They don't have to be at the top of their class when they are going out to get scholarships. You don't have to be low income where you're going to get financial aid. This will literally apply to any student in any situation. And again, it does not require you to get scholarships or financial aid. So even if you are a high income family and you're not going to qualify for financial aid, this will apply to you. And it works for younger students. If you're just starting to save for your future college costs, and it works for those of us who already have students in high school or early in college as well. And most importantly, it can be used to pay for college, or if you already have college loans, or you choose to use college loans strategically, then this can be used to pay back those loans as well. So, for those of you who already have a student in high school, who already has a student in college with college loans, this will apply to you by using the strategy to pay back the college loans. Okay. So I'm Corey Murphy. I have been in financial services. These are my two. I've been in this in retirement and college planning since 2000. By 2005, these two were about to start elementary school, and all I could think about was the dreams that I had for them, for college, and the panic, right? So I shifted my focus to college and funding, and since then have been working with parents to reduce the cost of college and pay for it. And as a bonus, I get to collaborate with top professionals, in the industry. This is me at a wealth conference in Florida this year. And we did not discover the retirement scholarship strategy. Our friend Lance Morgan gets the credit for that. And Lance has 5 kids or future college students, 2 of which are already in college. And his little guy there is in elementary school. So he likes to say there's a reason he doesn't have much hair left or that it's all gray because it's very stressful how we are going to pay for college. So just like me, just like you, just like Crystal, who's co-hosting with us behind the scenes, he knows the stress. He knows the sleepless nights. And when he discovered this strategy, he knew that he had to share it with others. And he taught it to us. And we are so excited to teach it to you. Lance also wrote a book back in 2018 called The Retirement Scholarship Strategy. It was an Amazon bestseller in the day, but the information we're going to share with you here tonight is more up to date, so you don't necessarily need to go out and buy his book. All right, so the Retirement Scholarship Strategy, let's dive in. Which is how to send your student to any school of their choice and get all of your money back in retirement without needing scholarships or financial aid. And even if you have a student in high school now or a college student now, this strategy works for you. Okay. Now, here's the problem with traditional college funding, and let's go through that. Maybe like a 529 account or another savings account that you pay for college. This is your kids may choose to go to a non-qualified form of education. Like maybe they want to go get that marketing certificate, or maybe they want to go to a trade school, or maybe they want to start their own business. It doesn't qualify, and you get penalized if you don't use that 529 money on a qualified educational expense. So that's one thing to consider. Also, you may have a financial emergency and need access to this money while your kids are growing up. But if it's all tied up in a plan that has to be used for education, then you aren't going to be able to access that money when you need it. Another thing to consider about traditional college funding accounts is that the Student Aid Index, the SAI, which is basically a number that determines if the college is going to give you any free money. So they are going to look at your income, your assets, and determine if you qualify for that free money. So you don't want to show a lot of liquid assets on those financial aid forms so you can get that free money from the schools. If you have a 529 plan, for example, then those schools are going to look at that and say, hey, we don't need to give as much free money because you already have a lot of money in these 529 or another college funding account that you can just use to pay for school. So we want to look like we need some free money from the schools, and that's another reason why we don't like traditional college funding accounts. Also, the market could be down when you need the money, right? The market is always up and down and up and down. And if you're trying to pay for college and the market is down, and your money in that college account will be down. And now you're spending it on college and cutting your losses. But we aren't supposed to sell low, we're supposed to sell high. So the timing of the market could also be another consideration. But the biggest reason, the number one reason why we don't use traditional college funding accounts is because it interrupts the compounding interest. Now, you might be thinking, well, of course, that's what it was designed to do. It was designed to be spent on college, right? But that's the old way of paying for college. The old way of paying for college is where we save, 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 and then we spend it on college. Now, you may have been saving since your kids were born, or maybe you haven't had kids yet, or maybe you want to start uh, early, or we're late and the kids are already in college. Doesn't matter. In either scenario, you're saving one way or another, and then you're spending all of that money down. The problem is that we're giving up that interest on our money. And here's an example. So if that money could have been earning 6%, then all of this money at 6%, we miss out on that growth. The growth, this growth, this interest, it's going to be gone because we're spending that money on college. So if we're interrupting the compound interest, if the school costs $25,000 a year per year for 4 years, it doesn't just cost $100,000 to pay for college. At 6% over these 15 years, it could cost $250,000 by the time it is all said and done and we miss out on that interest. So there is a cost to college, but there's also an opportunity cost to paying for college. Oh, all right. So this is, let me skip a step. Nope. Good. All right. So this is what Lance calls killing the goose that lays the golden eggs, right? Now, as your money is compounding, you spend that money on college, then all of the interest that is compounding, we're not going to get. And that is the biggest cost to paying for college. So the big secret is that everyone finances college. Everyone finances college. Either we are paying interest on loans or we're giving up the interest that we could have earned by paying cash. There is the cost of college, and then there is the opportunity cost of college, of paying for college. So we're here tonight to introduce a new way to save and pay for college. All right. So what if you could borrow the money to pay for college without a required loan payment, with optional loan payments, with less interest than you could earn on your savings? So what if we could show you where you could earn a safe 6% return or better and be guaranteed to borrow that money at 5% to be able to pay for college with optional loan payments? That is the secret. But now on the loans, you don't have to make the loan payments. But if you don't make your loan payments, that just like compound interest, as long as the money continues to compound, we're going to benefit from the spread. A 1%, as an example, positive spread. Okay, so we're saving, 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 and we're earning on average 6% or better. And then our loans are accumulating and compounding at 5%. And then the difference is that 1% spread. So 1%, maybe we get 2%, maybe we get 3%. But even with a positive 1% spread, this could give you the entire cost of college back in your retirement years. So if you had the choice and you had these loans at 5%, or you could earn 6, maybe 8% on your compounding interest, and every month that you're earning money, you spent some money on your lifestyle, and then you had the choice of where you would put the rest of that money. Should we put that money over here on our loans, or should we put that money over here on our compound interest? What would you rather do? Okay. Would you rather pay on the loans, or would you rather put that money to work compounding and earning interest? If you're really going to earn 6% or better, right? Okay. So let's go to that. Now, it's kind of like two cars, right? Going across the country. Let's say one car is going 60 miles an hour, one car is going 50 miles an hour across the country from New York to LA. Now, by the time they leave the neighborhood, there's not going to be very much difference between the two cars, right? But by the time they get all the way across the country over here, there's a big difference. Now, for those of you who already have high school students or college students, we aren't talking about the next 3 to 4 years. We are talking about the rest of your life. Okay. So if you're in your 60s, even, you've probably got another 20, 30 years, maybe even 40 years. That's a long time for you to benefit from the power of compounding interest. All right, so how do we do it? How do we actually make this work? Well, we need 3 components to make this work. We need uninterrupted compound interest. You've heard of compounding interest, right? But we need uninterrupted compounding interest. We don't want to spend the money. We want it to grow for the rest of our lives. Then we need loans at lower interest rates. Now, you can go out and get loans at lower interest rates, but do you have optional loan payments? That's the third ingredient or the third component. We must have optional loan payments. It doesn't mean that we can't pay the loans back, but it does mean that we need the option of paying the loans back. Now, I also want to point out something very important here, and that is that you are not in debt. You are not in debt by implementing the strategy, because you can always have the money that is securing the loans to use to pay off the loans at any time you want. So you're never upside down in this strategy. We could always use this money to pay off the loans. So we're never in debt. Okay, so let's compare. How about this compared to 529 accounts? Can we use our 529 account as collateral and take out a loan against it with optional loan payments? Nope, that's the problem, okay? Does it hurt your chances of getting free money from the colleges? Yeah, maybe so. But most importantly, it just doesn't work for this particular strategy. What about our bank savings? Of course not. Banks are doing the same thing I'm explaining here to you. The banks are the ones giving loans at a higher rate than what they're giving you on your savings. So we're trying to take a little lesson from their playbook and trying to do what they're doing. So of course, it will not work if you put your money in the bank. How about a 401k loan? Does your employer give you some money out of their pocket when you go to take out a 401k loan? Of course not. They're simply giving you early access to your 401k money without a penalty. But then you do have to pay it back, so it doesn't work for this strategy either. Margin loans. So, how about using your Amazon stock as collateral or just a generic brokerage account as collateral and borrowing some money from the brokerage firm? That is what we call a margin loan. So, it will work except the optional loan payments. When you take out a margin loan, they are going to want that loan repaid. Real estate. Okay. Wouldn't it be awesome if we could go out and get a home equity line of credit to pay for college without any loan payments? How cool would that be, right? Even if you could get qualified without jumping through all the hoops of underwriting. And what if your house continues to appreciate in value? You can take out a loan at a lower rate without loan payments. That would be fabulous. Okay. Unfortunately, there's not a bank that I have ever found that will give you a loan without a loan payment using your house as collateral. So, other than a reverse mortgage, but you have to be much older to qualify, and that's a topic for another day. All right. What about whole life insurance, like cash value life insurance? Ironically, this is where it gets interesting. So, insurance companies will let you use your cash value, which, if you don't know how life insurance works, there's the insurance portion of the policy, and then there's the cash value portion of the policy, kind of like a savings account in addition to the insurance. So, it's different than term insurance because it has a savings component to it. And well, we could use that savings component as collateral to take out a loan. Yes, yes, we can do that. And could we have optional loan payments? Yes, we could do that. However, whole life insurance is going to earn more like these are going to flop. It's going to earn more like 4 to 5%, and the loans are going to range somewhere in the 6%, 8% range. So the problem is that your whole life insurance policy is going to grow like this, and your loans, if you don't make loan payments, are going to grow on this higher green line. Okay. And that's going to create a train wreck, right? So it just won't work. But it does have that optional payment loan option. Okay. Now let's talk about the new kid on the block, the indexed universal life that you may all be seeing all over the internet these days. Everyone seems to be talking about this. And yes, it can earn over 6% on average. And we'll show you that in a few case studies here in a little bit. And you can earn that 6%, like I said. There are insurance companies also that will give loans at 5%, and they will give you optional loan payments. So this one can work. The only problem is high fees of life insurance, right? Remember, there's the life insurance piece, and then there's the cash value piece. And it's the insurance piece that is very expensive. And even the banks are using life insurance policies differently. Okay. So these are the secrets of the wealthy, all right, that you can use too. Banks are using these policies, billionaires are using these policies, large corporations are using insurance policies differently. Here's an example. If you go to bankdirector.com, you can learn how banks are using life insurance. And they say in this video how they're using it in a different than traditional life insurance contracts. Okay. They go on to say that it is high cash value, low insurance. That's key. High cash value is like your savings account, less the insurance. Now remember, the fees come from the insurance component. So if you have less insurance and more cash value, then your fees are going to be low. And it says here too that the cost is low compared to other insurance products, and that's how the banks are using it. Okay. Tony Robbins even wrote in his book called Money Master the Game, where he went around and he interviewed 50 or so of the smartest people in the world when it comes to money. And in this book, in chapter 5, he talks about what he calls the secrets of the ultra wealthy that you can use too. And he talks about how they are using life insurance for the tax benefits and of the life insurance. Okay. And he also goes in here and says that it's not even the billionaires that are using it the most, it's the banks and the large corporations. He quotes Wells Fargo had over $18 billion in their tier one capital on their balance sheet back in 2014. Now, I know that was a while ago, but it gives you an idea of what these banks and corporations are doing and how they're using these contracts differently. Okay. But the key is high fees equal high commissions. Low fees equal low commissions. So if it's done correctly, you can save a lot of money on the fees. Okay, so for those of you who aren't familiar with how life insurance works with cash value, I want to show you that using this $125,000 example of life insurance. And I do see that there's some hands raised, but we'll circle back to you if that's okay. All right. So with life insurance, there is a minimum that you can pay for that insurance, which is what most people are familiar with, right? That would be what we call term insurance, where we're just paying the minimum for that insurance component. But then there's the maximum. Now, this is where it gets confusing because if you ever, have you ever called up your insurance agent and said, yeah, what's the most I can pay for that car insurance? Of course not. But with life insurance, there is a maximum, and I'll explain why. Now, the life insurance company determines the minimum number and what that number is, and the government sets the maximum. Now, why does the government care how much we pay for that $125,000 of life insurance? Okay, that's because in the 80s, they came out with what are called qualified plans, like your 401ks, your IRAs, your SEPs, your simples, your 457s, all of those things. The government gets to tax that money when it comes out in the future. So if you think that taxes are going to go up in the future, you could be paying more taxes in the future when you take that money out than if you paid your taxes now. And during that same time frame, they also came out with what was called a MEC, or a modified endowment contract. Now, a modified endowment contract basically means that they're going to tax that money when it comes out if you go over this line. So for that same $125,000 of life insurance, you could pay $500 per year, or you could pay $10,000 per year. Now, why would you pay $10,000 for something that you could get for $500? Well, it's because if you pay $500, all you're getting is term insurance, just the insurance. But if you pay $10,000, you get what we call living benefits. Okay. And you get the insurance component as well. Okay, so it's much more than just the death benefit. If we want access to all of the living benefits, we pay more. And that's going to be like tax deferred growth, tax-free distributions of the money, competitive returns, high contribution limits, collateral opportunities, like tax-free access to the money through loans, no stock market losses, guaranteed loan options. You don't have to do an application and qualify to get these loans, unstructured loan payments, liquidity, use, and control. Okay, now the less you pay, you're going to get just the death benefits. But the more you pay, you're going to get these living benefits. Now, here's where everyone goes wrong. Okay, they learn all about these great benefits, but then they don't take full advantage. It's it's like building an apartment complex and you only have 30% occupancy. If you build an apartment complex, you want 100% occupancy, right? So where people go wrong is they go down here and most of their money is going into the insurance, and that's where it gets expensive. So in order for this to work, you want what we call a maximum efficient contract. A maximum efficient contract is where you have 100% occupancy and you're benefiting from all of the benefits of the loans at the lower interest rates, just like we looked at. Okay, so big secret, right? Low insurance and high cash value. That's the insurance company savings account. That's what we're focused on, not the insurance component. So here's an example of how this looks with low fees when we compare it to other taxable brokerage accounts like your IRA, your Roth, your 529 account, and an indexed universal life insurance policy. So as you can see right here, the index universal life insurance policy, the IUL, is much cheaper. Okay, 212, 182, 131, 65,000. At 1% in fees, if you're looking at it from a fee standpoint, it's different. It's not like a percentage like these other accounts. Okay, the fees of our IUL are based on the insurance component. So if we keep that insurance to a minimum, then look at the fees are at a minimum on this green line. The fees could actually be less than some of these other options if you do it the right way. If you do it the wrong way, and this is why everyone on the internet and your financial advisor might say, oh, don't ever use life insurance. It's so expensive. It's not an investment. That could be the case if it's done the wrong way. If you don't set these up correctly, then look at how the fees come in comparison to the other options. Now we're the green line up here. So obviously this does not make sense. And obviously it'd be pretty easy to talk you out of doing this if you looked at it, looked at the strategy done the wrong way. Okay, so again, this is the right way. And obviously there's a pretty big difference, right? Right. Okay, so sounds too good to be true, does it? How can these insurance policies earn 6 to 8% without market losses? Okay, it's not too good to be true. Here's how they do it. The insurance company puts most of your money into a general portfolio that looks like this. So most of the money is going into bonds, and not just any bonds, but high grade bonds. And as a general rule, this portfolio over time is going to average about 5%. So obviously it's based on the interest rates. Sometimes it's higher, sometimes it's lower, but as a general rule, over time, this portfolio is going to average around 5%. Okay. So what they do is they figure out how much do they need to save into the general portfolio to be able to get you your money back. So if you gave them $1,000, they figure out that they might need $950 into the general portfolio at 5%, excuse me, at 5% or a little better to get you back your $1,000, right? So now if that's only paying 4 or 6, that they'll vary some of those numbers, but as a general rule, 95% of your money every year goes into the general fund portfolio. Then, all right, there we go. And this is the general fund portfolio. All right, so then that means they've basically got the interest on your money that they can be a little bit more aggressive with, put it into the stock market through purchasing options on an index. So an example of an index might be the S&P 500. That's a common index. There's others as well. But that's why they call these index universal life insurance policies, because some of the money goes into buying options on the index. Now, if you aren't familiar with how options trading works, you could probably go watch a YouTube video on it. But it's basically like buying a lottery ticket and betting on whether or not that index is going to go up in the next year, in the year from when you bought that lottery ticket. So if the index goes up, your lottery ticket is worth a lot of money because you get to buy that index at today's price, which was lower when you originally bought the ticket. Okay. If the market goes down, if the index goes down, your lottery ticket isn't worth anything. So it's a high return, or you could lose all of your money, but it is just the little bit. You're only losing the interest on your money. You're only using this interest, you're protecting this principal. So our $50 might turn into $100. If that index goes up, that $100 is then added to our 1,000. We have $1,100. That's the equivalent of a 10% rate of return. So that's how we get double-digit returns without losing any money. Okay. The best that we've seen is really in that low 20% range. And that's probably the high end. There is no cap on certain products. Some products do have a cap. Some products do not have a cap on how much you can earn. But even the products that don't have a cap, I would say being able to turn that $50 into $200, that being a 20% return, that's usually the range that we're at, and that's on the high end. So what happens if the index goes down, right? We could lose our $50, but we would still have our $1,000 plus zero. We would just be at a zero rate of return. So that's where the range is. It's going to be anywhere from zero, guaranteed to never lose, zero to maybe, let's say, in the low 20s on the upside. Okay. All right, it looks a little something like this. When the market drops, you don't lose. When the market shoots up, you might not earn as much on the upside. Okay, but would you rather earn 20% on all of your money or 50% on just half of your money? Okay, do the math. It might surprise you. Believe it or not, that 20% on all of our money is a lot better than just getting 50% on half of our money. The key is that we don't lose, and it resets every year. So every year they draw a new line in the sand, and it looks at what is happening from year to year to year. So you don't have to get out of the hole in an IUL because it draws that line in the sand every year, and it's that reset that allows the money to always ratchet up instead of trying to make up from those market losses. Here's an example of one of our clients that started back in 2000. It was or 2007, excuse me. It was actually April of 2007. And at the time that this was illustrated, We illustrated it at 5.95%. That's what we were illustrating. However, the market crashed in 2007 and 2008, and this client got zeros for the first 2 years of their policy. So they were just under $72,000 at the end of 2 years, where we had projected $79,000. Okay. However, in the third year, they got just shy of 19% return on all of their money, getting them to 127, and we had only projected 121. So they got ahead of schedule in year 3, and they stayed ahead of schedule after that. And on average, that it was a 6.27% return. Now, what I like most about this example is they actually got 4 zeros in the next 14 years. Okay, that means that almost a third of the time they didn't make any money, but they didn't lose any money in the stock market. And their average has still been over that 6%. Now, some of our clients have done better than that. This is one of the worst examples that we can show you over a 15-year window. So as long as you can average better than the 5% on our loans, and we have that positive spread on our money, this strategy works. Okay. So this is one company that we work with that came out with this product in 2006. And they looked at all of their clients, not just one. So all of their clients through the end of 2022. So it's a little bit older, but that's where we are now. A little bit dated, but this is just to give you an idea that if you started in 2006 before the recession, you would have been averaging 6% so far. Now, this is not the actual return each year. This is the average of all the policies in 2006 since they started. If you started your policy after the recession, 2009-ish, then the average returns would have been 8%, 7% even. Now, most recently, because of the recent market corrections that we haven't made that 6% yet, but again, we're looking at this over the next, 20, 30 years of your life. So it's all about looking at the long term. You are guaranteed to be able to borrow the money with this company at 5%. So as long as you do better than 5%, then you've made that positive spread. So here's a little brochure on the fixed 5% loans with optional payments. It says here in their materials that this annual upfront interest rate is locked in when you purchase the policy, and it will not change. So even if you have younger kids, you are guaranteed to be able to borrow this money at 5%, even if it's 10 years from now, 20 years from now. That 5% is locked in and it will not change. And the rest of the money continues to earn interest on whatever index, whatever the index earns. So it could earn 16% one year, it could earn 0% one year, but over time, on average, if you're in that 6+% range, then you've got that 1% positive spread. Okay. Now, what if you're wondering, what if I already have a student in high school or a student in college? Is it too late? No. You just need to add one more element to this, okay? So, for example, earlier tonight I talked about that this was the biggest college savings plan of all and how it works for any school and any student, how it doesn't require scholarships or financial aid, how it works for younger students, older students, and that it can be used to pay for college, or here's the key, it can also be used to pay back college loans. So if you have a high school student or a student already in college and you don't have one of these plans in place yet, here's what you'll do. Okay. What you'll do is number one, you'll start with college loans to pay for college. So step number one is you use the college loans to pay the next semester's bill. Step two, you start saving right away into this insurance plan. And then step three, you use the insurance loans to pay back the college loans after graduation, because your college loans can be deferred on the payments. The payments can be deferred for 6 months after your student graduates. So you don't have to start making any payments on those college loans. You can make all of your payments here into the IUL and then use the insurance loans to pay off the college loans. Okay, so again, maybe over the next 5, 10, 15 years, you start saving money. And then after graduation, you start saving money here. And then after graduation, you pay back the original college loans. That's how you do it. If you have a student in high school or a student in college now, it is not too late. Now, what if the college loan interest rate is higher than the 6 to 8% return on the IUL? Well, there is a difference between compounding interest and decreasing interest. Okay, this is compounding interest. If you don't make any payments on the loans are compounding. If your money is compounding like this, it's the difference between the two that gives us that positive 1% spread and gives you that full refund in retirement on the cost of college. And I see more questions, but we'll come back to those. Okay, so if you have college loans, that interest on the college loan, even if it's a higher interest rate, that interest is going down every year because the loan principal is going down and you're paying those loans off. So how are they getting paid off, right? They are getting paid off when we take these loans at 5% and we go back and pay off the college loans at the higher rate. So you could pay all those college loans off in one shot. You could pay them over 5 years, over 10 years, over 15. It all depends on how much money you've saved into your plan. But either way, the interest is still decreasing on the college loans. All right, so let me show you actual numbers. So if we have a $100,000 loan outstanding at 8%, this could be a college loan, right? At 8%, and we're making our monthly payments of $1,250. Look at the interest. The interest is going down because the balance is going down. Yes, it is 8% interest, and that can be hard to swallow, but it's 8% interest on a smaller number every year. So it's decreasing interest because your balance is decreasing. So yes, this will still work if there are college loans, if the college loans are costing a higher interest rate than what you might be earning on the IUL. All right, there are a million reasons why you don't want to take out college loans. I know, but let's talk about why you might want to use federal college loans strategically to pay for college. Now, I know this is going to throw you off a little bit because everybody wants to avoid college loans, but let me show you something. I'm going to give you a sneak peek on secret number two, which is how to reduce the college loans and the college loan payments. And we have another webinar that dives into that in more detail. So this is just a sneak peek. The secret is using the college loans, and the secret is that the loan interest rates are not the most important consideration. Everyone, when they go to take out college loans, they're first looking at the interest rate on the loans. This is not the most important consideration. Using college loans strategically could save you the most money off of college, and it could be a huge, huge savings, which is another reason why we don't recommend traditional college funding accounts and 529s. We don't recommend retirement accounts, so whole life insurance policies, or even cash flowing college. Okay. We recommend using the federal loans to pay for college, and I'll explain why. Okay. Freshman year students can get 5,500, sophomore year 65, junior year 75, senior year 75,000, and if they have to go a fifth year, there's another $4,000 there. So it is a $27,000 student loan bill if they graduate in 4 years, or $31,000 student loan bill if they take 5 years to get their degree. Now, if they go into grad school, they can borrow much, much more in their own names. But for the undergrad, it's 27 or 31 if they have to go for 5 years. Right. Parents, we can borrow the entire difference from the government in federal loans. Now, think about this for a minute. It is true, the government will loan you money even if you don't make any money at all. Even if we make too much to qualify for financial aid on the FAFSA. As long as you do not have outstanding student loans that you've defaulted on and you don't have adverse credit history, you can borrow the money to pay for your kids' college, even if you don't make any money yourself. Okay, we aren't saying that we necessarily agree with this. We aren't saying it's right, but it is what the government is doing to solve the problem of the high costs of college. And the big secret behind that is income-driven repayment plans. If you don't know what an income-driven repayment plan is, you're going to be very glad that you're here. The loan payments in an income-driven repayment plan are a percentage of the income of the parent, not the parents that take out the loans, and not a percentage of the loan balance. Okay, think about that for a minute. The loan payments are a percentage of the income of the individual parent that takes out the loan, and not a percentage of the loan balance. You could have 5 kids that go to Ivy League schools and you borrow $1 million for them to go to school. Now, why would the government do this? We're not going to get into that, but this is how they're solving the high cost of college. So you take out the loan on the parent that makes the lowest income, even if they don't have any income at all. Okay. It is not about the interest rate on the loans. Okay. You can go out to studentaid.gov and look it up. Okay. On studentaid.gov, do a search on income-driven repayment plans, and it will say right there, if your student loan payments are high compared to your income, you may want to repay your loans under an income-driven repayment plan. And here are some of those repayment plans. And again, we have a whole separate webinar on that topic. There are old and new repayment plans out there right now. Some are being held up in the courts, and this being an election year, there's likely to be a lot of rhetoric and maybe some changes, but nevertheless, income-based repayment plans are not going away. It's a mouthful. You could pay 20% of your discretionary income up to 20, 25 years. And if you work for a nonprofit, a municipality, a government entity, a school, then you can also go into public service loan forgiveness or PSLF, and it would only be 10% of your discretionary income for 10 years, or technically 120 payments. But nonetheless, these are huge, huge discounts off the cost of college. So always want to do the math. Okay. What is 20% of your income for 20 years of the parent that makes the least amount of money? It's crazy, and you might not agree with any of it. We're just saying these are the plans that the government has put in place. It is completely legal. It is completely ethical. This is their solution for the high cost of college. Okay. Another reason that we don't recommend the 529 accounts or traditional savings accounts or even paying cash for college is this, and we do strongly agree that you roll the dice a little bit and start paying for college with these federal loans and see what happens. See if you can benefit from one of these income-driven repayment plans. You can always refinance a private loan at a lower interest rate or just pay them off if you want to, if you can. Okay. So again, let's go through this. Step number one, we highly recommend you use the federal loans to pay for college, even if you don't have to. Even if you could pay cash, we recommend using the federal loans to pay for college. Then you save as much money as you can into the insurance plan. Then you use the loans from the insurance company to pay back the federal loans or refinance the loans and still use the insurance loans to pay off the refied loans, whatever the case may be. But think about that as a strategy that could save you a lot of money. Caution, disclaimer, right? Always have to have one. You are dealing with the federal government. These are federal loan programs. These loan programs could change and probably have, if you're watching a recording of this webinar later. We always are going to recommend that you consult with a certified student loan professional. Yes, that is a thing. And yes, we have Luann for our clients. So when the time comes, when your student is 6 to 12 months from graduating from college, we get Luann involved to help us determine the best income repayment plans, to do the paperwork for us and get it all set up. And most important, we always want to plan for the worst and hope for the best. Okay, we strongly recommend this retirement scholarship strategy to be able to pay for all of the college and get all of that back. Plus, as these college federal loans and these repayment programs are here, you could potentially cut your loan payments drastically and save a lot of money. And then if you don't need all of the money that you've saved to pay back the loans, you could use it for retirement or something else. Okay. So let's review the benefits of the retirement scholarship strategy. Do we have a competitive rate of return? Yes, it is possible to get over 6% on average. It doesn't negatively affect our student aid index number because the savings account portion of the insurance does not get reported on financial aid forms. It's that simple. Okay. There are low fees if set up correctly, tax deferred growth on our money, and tax-free access to our money through loans. The IRS doesn't tax loans. Okay. No stock market losses, guaranteed loan approval, no credit check, no application, no underwriting, fixed 5% loans, not variable. Now, some insurance companies have variable loans. So make sure that it's a fixed loan that won't go up on you, or the whole plan is going to go south, right? High contribution limits. You can save into this plan as much as you want, to a certain extent, of course. Flexible contributions. Maybe you had a bad month or a bad year. Sometimes, we get a call from a parent that needs to put their payments on hold for a bit. You can put your payments on hold. You have flexible payments into the plan. And of course, you have access to the money. Okay, so let's tie all of this together and get into some case studies. Now, in the case studies, I am going to show you a 6% average rate of return on all of them. The range could be from 6 to 8, but I'm going to show you 6 and I'm going to show you 5% loans. I only want to show that 1% spread, even though you could get to 3% positive gain. I want to show you what it looks like with only a 1% spread. Okay, so let's first look at what not to do. Okay, this is what not to do. If you ever Google this, or you look on the internet, or you talk to your financial advisor and they tell you, don't use life insurance, it's too expensive, this is what they're talking about. In this example, I want to walk you through all of these columns, and we're going to see why this doesn't work. And then I'll show you, of course, the case studies that do work, right? So if we're looking at the contribution amount, so the contribution is how much you're paying. It is not how much you are required to pay. It's just how much you're contributing, okay? The expenses is how much you're required to pay. Now, in this case, $10,000 is based on this insurance over here, 290,000, and you're going to find out in a minute that this is not actually full occupancy. This is not how much you could put in. In fact, this is too much life insurance. So this $10,000 a year over here is going to cost almost 36% in fees. This is why people freak out about high fees. Okay, but this would be the expenses here. The interest would be about 6%. And if you're earning 6% and the fees are 3,600, obviously you're starting out in the hole, right? So in fact, in 10 years, you don't even have as much as you originally put in. The account value is less because you didn't have full occupancy. All right. And then the expenses, let's talk about those just a little bit. The expenses are here because the insurance company they have expenses to set up the account. They have to pay the underwriter. They have to pay some commissions up front. There's all these expenses, so they can't give you access to all of your money on day one at the beginning. But in this example, they don't even have access to all of their money until much, much later, right? In year 3, they only have access to a third of the money. And it's not looking very, very good even in the later years. So, of course, heaven forbid, if we died, then we would get all of our money back. But we don't want to have to die to get this money back and for this to make sense. But the biggest problem is what happens later on as you get older. The total expenses, the cost of the insurance, watch that continue to increase. Watch the insurance stay at the same level. We get down here to the end, and the cost of the insurance, the expenses, as we get older, they continue to go up and up. And I can come all the way down here at the end and look at these expenses. They have gone way, way up because we're still paying on $290,000 of insurance. I'm getting older. I'm in my 80s, we're in our 90s. And now the cost of insurance is higher than the interest that we've earned in the account. Now, remember, we never put more than $100,000 in over those first 10 years, and then we stopped. But the expenses didn't stop. The expenses got so high that they became higher than the interest that we were earning. So that doesn't look very good. That makes no sense at all. And this is the reason is because of this insurance. The insurance was too expensive. That is why the fees went up. And that is why this would not make sense. Okay, so let's look at the right way to do it. Okay, in this example, we are still doing 10,000 a year for 10 years. It's the same 50-year-old client. In the first year of the policy, they're going to be 51. Well, we're still going to stop making payments after 10 years, but now our fees have dropped a lot. We're at, instead of 36%, we're at 18%. Now, before you panic, that's because we haven't dropped the insurance, right? So here is that secret that we were talking about. Here's the big secret of the whole thing. It's that after you're done making your payments into the insurance, you can reduce the insurance even more. Now, that is what causes the fees to drop, okay? Now, look at the interest. It only takes 1, 2, 3, 4 years, and we're earning more interest than our fees, okay? So we're at 10, 20, 30, 40, 50, $60,000 right here. 1, 2, 3, 4, 5, 6 years here. And we have just as much money in our account as we have contributed in the beginning. Now, remember, they don't give us access to all of our money until about right here. Right about there. Okay. We still have access to quite a bit of it. And again, if you have high school students and they're in college here, then we're using college loans to pay for college. So for 4 years, while the kids are in college, we can build up this money. Okay, hopefully that makes sense. Now, again, we'll look at the expenses and look at the insurance, and let's move down to there. After 20 years, our expenses, 26,000, and we've been able to drop our life insurance down to 35 and cut those expenses. Okay, if we go all the way to the end, now instead of $460,000 of fees, it's only $65,000 over the life of the policy. Not bad at all. And we've earned $1 million at 6%. And our insurance stayed low. That is the key. Keep the insurance low. That keeps the expenses low, and it allows your cash value to grow. That's the key. Okay, now let's look at what it would look like if we had a student who was going into school in 11 years from now. Okay, so we've saved our $10,000 over 10 years. We've saved our $100,000, which you could save it over 20 years. You could save it over 5 years. There is no rule, but you do have to spread it out over a minimum of 5 years to avoid any IRS issues. Okay, so the minimum of 5, but you can do as long as you want. And again, this is not a required payment. These are the required payments. The expenses are the required payments. technically they come out of the account. So we don't even have to make a payment. We could skip a payment and the expense would come out of the account. Okay. So later on down the road, we could use our account to as collateral and we could take these loans to pay for college. Now, $25,000 a year, 10 years from now, probably isn't going to be enough to pay for college. It may not be enough today, but but maybe you can only, help your kids with some of it, with half of it. That would be an example. Okay. But what I want to point out is this. What I want to point out is that while we're borrowing that money, it does not interrupt the compounding interest. So I want you to think of this like a house. And I want you to think of these loans like taking a home equity line of credit each year. You're just borrowing against your home equity line of credit. And if you borrow against that line of credit, it doesn't change the value of your house. The house is still increasing in value. You're not interrupting the compounding interest. The compounding interest is still growing. Now, if you take a loan and you don't make any payments, then yes, the loan balance is going to compound. And as we move down, we could see that that loan balance, this column right here, the loan balance is getting bigger. Your interest is getting bigger. This is compounding interest, right? But again, remember, as long as the money is compounding at 6 and your loan is compounding at 5, we have a positive 1% spread. Okay. Again, as long as we're compounding at 6 and the loans are compounding at 5, we have that positive 1% spread. Okay. So now we've borrowed $100,000 to pay for college. And right here is where we get our full refund. Here's our 100,000, here's our available cash, and right here is where we get that full refund on the cost of college. Now, we could use that money for retirement, for weddings, for other investments, whatever you want. All of this money can be borrowed tax-free, okay? And all of it can be used along the way. We don't have to wait, okay? One more thing, you are not in debt, okay? Because you could always pay off this loan balance with the money that you have in the account. So you are never in debt. Okay. So now what if we have a high school student or we have college students? How is this going to work for you? Well, while the kids are in college, okay, you use the federal loans and defer the payments until 6 months after graduation. And let's say in this example, you have 2 kids in college. So after the first one graduates, then let's say their loan payment is about $9,000 a year, $9,100. And then 2 years later, we have our second student and they have their loans to pay back for 10 years. So we start saving now to get a head start. And in this case study, it's 18,000 a year because we have 2 kids. So starting now, and then when our kids are starting now, when our kids are in high school, and then we take out the loans from the college loans to pay for college. And then when they graduate, we take the loans from the insurance company to pay back the college loans. And yes, there is some overlap, right? We're paying on college loans while we're still contributing to the policy, okay? We're borrowing and we're still saving at the same time, okay? But this money is averaging 6% and the loans are costing us 5%. So we still have that positive leverage, okay? And same thing, let's look at the available cash. Oops. The available cash over here, okay? All right. So over time, we will eventually get all of those contributions back. We will get a full refund on the college costs. Now, a lot of it's going to depend on age. It depends on how much money you're saving. There's a lot of variables here, but you can see this compounding interest is never interrupted. And it's about age 80, 81. We've put in $180,000 to pay for school. We've borrowed $195,000 to pay the loans back. And somewhere here, 80, 81, we get a full refund in retirement. Okay, let's go all the way to the end of this. Okay, you've never interrupted all of that compounding interest. You never spend more than the original contributions of 180. The interest has grown to over 1.6 million here. We've borrowed 200,000 to pay for college. That loan amount has now grown to over $1 million. Where's the insurance company going to get that $1.1 million when we die? Okay. They are going to take it out of our account balance. They are going to take this 1.1 million out of our account balance of 1.7 million, and your family, your beneficiaries, get everything that is left. And that's this over here. Okay. So here's the key. I want you to think about this. This is a good deal for you, but the insurance company has to stay in business. So for this to work, how do they benefit? Okay. They benefit from the expenses when you die. They benefit from all of that loan interest. It's an investment for them. If you're paying them 5% interest, even if you're not making those interest payments, that interest is growing. The loan balance is growing. And someday when you die, they will collect on that interest. And out of all of this, $646,000, how much do they actually have to write a check for out of their pocket? Okay. It's only this $17,000. Okay. This money is your money in your savings account. And this money, they only have to write a check for to give your beneficiaries tax-free the $664,000. Okay. And all of this, you don't have to wait until retirement. You can use this in your retirement years for anything that you want. And it all comes to you tax-free, income tax-free, and it goes to your beneficiaries in the form of a death benefit. Even the savings, all of it comes in the form of that death benefit to your beneficiaries. Okay, now let's look at another one. Let's say we have these two kids and your college costs are going to be 160,000 for each of them. So 320,000 together. So you might need to save 32,000 a year for 10 years to get to 320,000. And then everything works the exact same way. Now, you're going to have higher expenses because you have higher insurance, but you can still reduce the insurance after you're done making contributions. Now, even though your expenses are higher, the interest is higher, and so is your account value. And of course, here's your contributions. You can use that account value as collateral to take out these loans and borrow all of this money from the insurance company. Okay. And remember too, you are never in debt because we can use this money to pay off these loans at any time that you want. All right. And then we just let the whole thing grow and watch this available cash column here. Okay, so we're putting in the 320 and never any more than that. And eventually we gain that full refund back off the cost of college. But again, you don't need to wait that long to access all of this money. You can access it for whatever you need or want to. Okay. Now, you could keep saving if you want. You don't need to stop at 10 years. You could spread it out over 15 years or 20 years if you want to. The same concept applies. Now, if you kept saving that and you didn't need to do it in 10 years, you wanted, or you couldn't do it in 10 years, you wanted to spread it out over 15, again, it's the same, it still applies. This is the same $320,000. Here's the same $349,000 that we borrowed to pay for school. And again, we get a full college refund somewhere around 70, 90 years of age in retirement. And you don't have to wait that long to access that money. You could use that money at any time to pay off those loans if you wanted to. Okay. If we let this thing run and we look at the end of our life, okay, here's that same 320. We never put more in than that. The insurance company took 86,000 in expenses. We earn over $1 million of interest for an account balance of over 1.2 million. We've borrowed 350,000 in life insurance loans to pay back the college loans. Now, what if you could get some sort of income-driven repayment plan and keep a lot of this money? Again, we want to plan for the worst and hope for the best, okay? So there's all that interest that the insurance company gets when you die. That comes out of your account, and then this savings balance goes to your kids. So it's the remaining balance in your savings account, the life insurance component together, and that gets the 393. Okay. Here's an example of how you could use it in retirement. So this is the same scenario, same case study, but now watch. If we come down here to age 71-ish, we can start to borrow money in retirement to supplement our retirement income. Okay. And we can take out these loans in retirement just like we took out loans to pay for college, and it is all income tax free. So Lance likes to boast that his biggest client is living off of $250,000 a year in loans and shows no taxable income. He doesn't have his Social Security taxed. He gets his full Social Security benefit, and he's living off the loans of his insurance policy. Okay, this is the secret of the ultra wealthy that Tony Robbins talks about in chapter 5 of his book. Okay, so I'm going to keep going. Let's take a look at another one. All right, so maybe you already have a lot of money saved. Maybe you have a lot of money in a 529 account, or it makes sense to pay a little penalty on those gains. So remember, if you move your 529 money, you would pay a 10% penalty on the gains and taxes on the gains portion. But if you spread that out over 5 years, you only pay a fifth of the taxes and the penalties each year. And it allows that money to keep compounding interest over 5 years. And there's also that opportunity cost of having paid cash for college. So if you pay cash for college, right, then you're going to give up that interest you should have earned on that money. but maybe you have this money in a savings account or in a brokerage account. Maybe it's not in a 529, whatever the case may be. You could move as much as $1 million over 5 years and still pay back all of those federal loans. Okay. Yeah. Over $1 million in federal loan payments or private loan payments. Hopefully, you could get an income driven repayment plan and not have to pay all that money back and keep your $1 million for retirement. But nonetheless, almost $1 million in and borrowing over $1 million to pay back for college. And same story, right? You get a refund on the cost of college. And I know those are some big numbers, and you may not have that much money saved, or you may not even have that much money at all, like some of us. But and you may need to spread it out over 15 or 20 years, right? This can work in smaller chunks of money. If we have to spread it out over 10, 15, 20 years, that works too. We just have to spread the loan payments out over 10, 15, or 20 years, right? So maybe we can't pay the loans back after 10. We spread that out, but it's the same concept. So here we've contributed 162,000 for college. We've utilized 189,000 to pay back those college loans. Here's that same 162. Okay, we've spreading it out over 10, 15, 20 years. So we spread the loan payments out over 10, 15, 20 years. And then we still get that money back in retirement. We just have to wait a little bit longer. It's going to take us a little while longer to get that full refund of college costs. We're going to be in our late 80s instead, at that 1%. But remember, again, we don't have to wait until we get all that money back to utilize that during retirement. There's enough money here to buy a car, put a down payment on a house. So you still have more money than what you paid in for college. So even if you can only do a little bit and you have to stretch it out, it's still going to benefit you. Okay, so this strategy, if you don't end up using all of your money and you have money left over, this strategy can be used for all kinds of things, right? So we talked about paying for college. We talked about paying college loans back. You could use any leftover money for weddings or any major capital expense. Maybe you want to start a business or invest in a business. You can use it for tax-free retirement income and other investments. Maybe the stock market is down and you want to use this money to invest in the stock market. You could do all sorts of things with this particular strategy. Okay. But caution, right? Caution. Not all life insurance is going to earn 6 to 8%. Not all insurance companies are going to offer fixed loans at 5%. Your advisor, your financial advisor, will tell you not to do this. Okay. And insurance agents are going to try and sell you too much insurance and make those expenses too high for this to work. Okay. And the reason that I know this is because when I started in college funding, I was a traditional licensed financial planner, had a nice office. I did a lot of assets under management where our goal was to invest people's money for a commission or a 1% fee. And then I got a residual off of all of that. I did a lot of mutual funds. I managed the 403(b) accounts for all the employees at our local hospital, and IRAs, Roth IRAs. I taught a lot of people how to use 529 accounts. I even had them for my own kids when they were little. And I also taught people not to use life insurance because the fees were too high. There was no way that you could get 6% on average. And that's because I didn't understand the details of how these plans work. And I was wrong, right? I learned from Lance very quickly how these plans work and I left traditional financial planning to focus solely on the college planning. And it can work. And a lot of us, a lot of those traditional financial advisors, they're not doing it because they're working for stockbrokers, and the stockbroker wants all the money in the stock market. And so they are going to tell you that these plans don't work. So I want to encourage you to look into them, to understand how they work, because they do when they're set up correctly, and it could save you so much money. Okay, so pros and cons. Pardon me. No college funding plan is perfect. It just isn't, right? But there are 5 considerations that we have to have. So, number 1, this one, it does require more discipline and consistency. There is flexibility in the money that you're putting in, but it's like buying a piece of real estate. There's some expenses in setting up this insurance. You can't just take your kid's birthday money and throw it in there once a year. It needs to be more consistent for this to work. There is limited access to the money in the early years, right? The insurance company doesn't give you access to all of the money in the early years, and there's a number of reasons for that. But it's okay because you can get college loans to pay for college, and then over that 3 to 4 year period, you have enough money to then begin to start paying those college loans back. Okay. The insurance company has expenses to set up the life insurance. They have to pay underwriters. They have to buy these bonds, and they're 10-year long-term bonds. So they can't give you access to all of the money up front, but you still have access to a lot of it. Okay. It is life insurance, so you have to qualify. If you have health issues, then hopefully you have a spouse that doesn't have health issues and they could qualify. So that's something to consider. The US might file bankruptcy, and you may not earn 6 to 8% on these plans. But now here's the thing, right? Remember, you're not in debt. You can always, at any time, take your money and pay off the loans. So if your money stops growing and your money flatlines and your loans go up, you don't have to let that happen. You can pay off your loans at any time because you have that money that you're using as collateral. But most important, it requires a different mindset. Okay, new mindset, new results. So these are some of the comments that we get that Lance has gotten on social media. Forget what you already know. Be open-minded. Be open-minded. Keep an open mind. You have to have a different mindset. Eye-opening, enlightening. Alternative ways to pay for school. Right? Very informative. Change my perspective on how to fund the kids' college expenses. These are always the type of comments that we get after doing these webinars. This one is the most fun. It might seem like magic, but once you get it, it's magical. So very clever, very clever. All right. This article here, this was published a while back. And in the article, it talks about the IRS files reveal how the wealthiest avoid income taxes. So, how do the wealthiest, the mega billionaires, pay their mega bills while opting for low salaries and not selling off any assets? According to the experts in this article and the public documents that they reference, the answer for some is borrowing, and they borrow a lot of it because they don't consider debt to borrow the money. They don't consider that as bad debt because they know that they always have the money and they could use that to pay off the loans if they wanted to. So that's the shift. That's the different mindset. It's not just taking out loans to get into debt. It's about using loans strategically and using your money as collateral so you can always pay those loans off if you wanted to. Okay. So here's the comedy portion of our presentation. Let me ask you a question. I'm going to leave you with this. Lance likes to ask, would you jump out of an airplane without a parachute for $100,000? Would you jump out of an airplane without a parachute for $100,000? No, of course you wouldn't. Even though $100,000 would go a heck of a long way to pay for college, we're not jumping out of any airplanes without parachutes, right? Not going to happen. But what if that plane was on the ground? That changes everything, right? Had we known that that plane was on the ground, we wouldn't have just missed out on $100,000 because we didn't have all the facts. So the reason I bring this up is because we want to talk to you. We want to run your numbers. We want to answer all of your questions. Please don't jump to any conclusions until you have all the facts. It's free. There is no obligation. You wonder why? And it's because through this work, you need less insurance and more cash value. We still get paid a little bit of a commission on that insurance, even though, if it's set up correctly, you're going to have the maximum cash value. There is going to be a little bit of commission there, and that's how we make our money. So we can also help you with other services. We can help you fill out financial aid forms, find schools, maximize scholarship money. We work with students on their admissions applications, their test prep. There's a lot of other stuff that we could help you with also. But this portion, running numbers and the retirement scholarship strategy, that is completely free. We do not charge to run numbers on that life insurance and to show you how it works. So we'll show you which insurance companies are best. We'll show you how to make sure that the fees are the minimum fees, can show you how to access that money, how to borrow that money. We'll meet with you every single year and maintain that plan to make sure that it stays on track. So every year we're going to compare, here's what we illustrated and here's where we're actually at. So if you want to work with us, if you want us to run some numbers, again, it's 100% free. You just have to scan this QR code, or maybe Crystal will put that in the chat. And that's a wrap. Thank you for watching. I think we have time if anyone wants to stick around.
I'm going to field you some questions.
Go through questions. Okay.
So I was responding to some, but Juliet had, my understanding with income-driven repayment plans is that if you file jointly, wouldn't they look at your repayment plan based on your combined income and not the income of the lowest earning parent?
So that is a repayment analysis and strategy. So the loans are taken, the federal loans are taken in one parent's name. So one parent secures those loans. Then when you're 6 to 12 months ahead of your student graduating college, that's where we get our certified student loan professional involved. And we have her do the math to say, okay, here's your standard repayment. Here's your income-based repayment options. Here's your income-based repayment options if you file your taxes jointly. But at that point, you may choose to file your taxes separately because here's the numbers. And when you file taxes separately, then yes, those income-based repayments are based on the one parent's tax return. Now, that's a lot of math, and that's exactly why we do that analysis, because filing married, filing separately is going to cost you more in taxes, but it might save you a lot more in loan payments and interest too.
And we did do a session solely on that as well. So if you want that access to that recording, just shoot us an email and we're happy to get you that as well. Tammy said, what is the difference between IUL and VUL? My response, let me know. So the question is there anything to add to this? The indexed has a floor where if the market goes negative, you don't go negative, you just credit zero, but variable does not have a floor. Therefore, you don't have that safety net.
That's good. Yeah, an indexed universal life, we're buying indexed funds. So it's a group of funds that are designed to track an index. A variable is going to be more like a traditional mutual fund where it's really going to go up and down. You're not going to have the floors and the caps like you would. It's more volatile. It looks more like a traditional investment. Mhm.
And then I think I clarified this, but is kind of a good segue in is the, everybody qualifies to borrow federal loans. All we have to do is fill out the FAFSA. The biggest distinction is those that have low income can get a portion of that subsidized by the federal government while they're in college. But primarily the chunk of loans that you are borrowing are as a parent on the parent side, which will have an interest rate, which is why Corey was showing that distinction between, yeah, 8% in terms of borrowing for the interest rate on these loans versus the what we're earning in the account. So what is that spread, right? Like recognizing that this is a long-term game and that everybody has the ability to borrow, and there's two different sets of loans that we're looking at from the federal government, where unless you have adverse credit history like bankruptcy or something very serious, everybody qualifies as a parent to borrow for the total cost of attendance of a school. So I just wanted to clarify
Yeah.
that verbally
Yeah, the
for,
student loan amount is so small and they can only get so much. So the difference is on us as parents.
yeah.
Mhm.
And then Teresa had asked, like, how much do I have to contribute each year for an indexed universal plan? And my response was, that's going to be based on your situation. And that's a fabulous conversation to have with Miss Corey to make sure that you are clear on how best
Yeah.
to set that up.
The minimum, I know, and I will say the minimum for this to work is $500 a month. Right. So whatever that $500 a month is going to accumulate by the time your kids' loans come due, that's how much you'll have to pay back their loans. So let that might be all that they need. It might be half of what they need. But those are the numbers that we can run. And then there really isn't a maximum of how much you can put in. So what we do is we balance how much do we need for college, how much can we afford to contribute, and then we figure out, is that going to pay for half of school, 75% of school, or all of school? And you do the best that you can and then figure out the rest when the time comes.
Yeah. And this is a good one. So Melissa asks, if you can save and invest on your own, is the benefit of the IUL product primarily the tax-free loan feature?
That's a big one. Absolutely. The other is the death benefit. Um, God forbid something happened to you while your kids were in college, and they couldn't, you were gone and they couldn't pay for college. There's also the benefit of uninterrupted compound interest. If you're saving in a traditional savings account and or any type of an account, and you're using that money to pay for college, then you're spending it down. And as you're spending it down, you're interrupting the compound interest, and the principal that is earning interest is shrinking. So the interest that you're earning is shrinking. So with the insurance, it allows our account value to stay high and that interest to continue to compound without interruption. And we get the benefit of the cheap loans at 5%. We get the death benefit. We get all the things.
Mhm. And I think the answer to this is yes, but Ahmed asked just to make sure the money is available only via the loans to myself from the insurance account at the 5% that I can use to pay for college and other expenses. And it's and the reason why we loan it, just as a reminder, is because then we don't pay taxes on it. We don't withdraw because then you get hit by the government for
Mhm.
taxes.
You
If you
can
shelter,
withdraw. Like
you
there's
can.
no rule. You can withdraw it, you can loan it, you can get your money.
It's just a
But
matter of how much you want to pay taxes on.
yeah, 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 exactly. Loans
Put
are not,
zero
debt is not
or
taxed. Mhm.
Let's see. Oh, playing devil's advocate. It
Please.
seems like if you can save enough to contribute 10,000 per year to an IUL policy, for example, you could just pay that cash directly to the college. So why put it in a policy for the residual account value and death benefit? Question mark.
Right? It's for that uninterrupted compound interest. If we are paying cash or here, what you're asking is why, pardon me, I'm a visual person. This one. Um,
We can't see it. Oh,
I
there
know,
it is.
I'm getting there.
Okay.
I'm getting there. Um, this one. If we save, and or we pay cash, as soon as we're spending that down, we are missing out on the interest that we would have earned on that money. So it's the opportunity cost of what we would have earned on the money, and then all the benefits of the life insurance. In the life insurance, because we have that compounding interest, then that money continues to compound, and later in our retirement years, we get it back. If we do it like this, we save it and we spend it, it's gone. It's just gone. So that's the mindset shift that we can talk through.
Yeah. We got to the end of the question.
Oh, you must have answered quite a bit because I saw that like in the
Well,
20.
yeah, you get to see it when I'm replying. So you think that there's a lot of things
Ah,
going in there,
okay.
but it's really just me.
Very good, very good, very good.
I
Okay.
did put the link in there, and there will be a follow-up email that goes out to everybody with the access for the recording as well as the link to be able to schedule with Corey. If you have questions or you want access to any of the other things that we post, like Miss Corey was saying, feel free to reach out and let us know. We are happy to point you in the right direction. And fascinating concept and good idea to offer webinars. Thanks. You're welcome, Melissa.
I'm pretty happy with my own plan and how I didn't mention that, but yeah, my daughter's a senior in college and this is how we're doing it.
Mhm. Yeah, mine's only 7, but I have already started that game. But
I'm
that's because
jealous.
I knew what I knew, and so I already
Yeah.
played the game.
Yep. Yep.
Yeah. Well, thank you so much, everybody, for joining us, and I hope you guys have a fabulous rest of your evening.
Bye.